Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about how to set smart trading goals. Okay, so seeing as this is the beginning of the year, and this is actually the first ITU Forex class we're going to be going through in the year, this is the best time for you to set smart trading goals that you're going to work towards throughout the rest of the year. Okay? But the thing is, knowing that you should set goals while you're trading and then setting smart trading goals are two different things. Because most of the times, the problem that happens is that traders who are, especially traders who are struggling to become consistently profitable, or traders who don't really know what they're doing in the market, they're just dabbling in the market, but they don't really have, a clear plan of what they want to do or what they want to achieve in the market. They usually just trade without setting goals, and that's the absolute worst way to go about doing this. Okay? And that's why in today's episode of the ITU Forex class, we're actually going to be talking about how to set smart trading goals. Okay. So most of the times traders think that setting goals like I want to make, $100,000 this year, or I want to win more trades, or I want to do things like that. They think those are good trading goals, but actually they are not. Because the problem is, if you've been around the personal development spaces, you've hung around this personal development spaces, you must have heard about the term or the acronym SMART goals. Okay. Now, the thing with SMART goal settings is that the SMART word right here is not actually the word SMART that you know. It's just an acronym for setting specific, measurable, achievable, realistic, and time-bound goals. Okay, so for your goal to be real, for your goals to be good, or a good goals that you can work towards, they need to be smart goals, which are going to be measurable, achievable, realistic, and time-bound. Now, when somebody tells you that he wants to, his goal is to make $100,000 a year, it's okay to strive towards doing something like that. But the problem with that kind of goal is that it's actually not very specific, because you're just saying what you want to achieve, but you haven't clearly outlined what you would need to do in order to achieve that goal. Okay, and how you're going to track when you achieve that goal, when you're going to know exactly how you've achieved it or what you're doing towards achieving that goal, and all of those things. Okay, and that's why this is one of the most important things you need to really set down to do. So I've given you an example of what bad goals are, but what are good goals, for example? A couple of examples of smart trading goals are something like, I would like to follow my rules for the next 90%. This is you striving, actually. So you would want to take follow your rules on the next 100% of trades you take. But at least if you're not even able to achieve that because of some errors you couldn't navigate through, at least strive to make 90% of the trades you take follow the rules of your trading strategy or your trading plan over the next set of trades you're going to take. So for example, like 30 trades. Another example of a smart trading goal would be something like, I would like to risk exactly 1% or less of my trading account's capital on every single trade I take this month or this year. Okay. Another one would be, I would like to trade only my A plus trade setups during London and New York session. This is assuming that you've already back tested and for tested or live tested the trading strategy that you're using to trade. Okay, so you already know that you have something that's proven to work. The only problem here is that you are actually, emotions and lack of discipline is making you break your rules and not follow that thing, because you've already proven that it works through back testing and for testing and live testing and all of that testing process. Okay, so assuming you have something that you know actually works, but the only problem here is that you are getting in your own way by not following the rules of that particular trading edge that you've got. And so that is sabotaging your trading results. So assuming you've got this, and now discipline is the only thing that is preventing you from becoming profitable, then you want to set smart goals, which would help you to remain disciplined and actually achieve that particular favorable outcome that you're looking for. Okay. So another, one last example of a smart trading goal would be something like, I would like to journal every trade I take within a 24-hour period. The reason why these goals are smart is because they're specific. Okay? So it's very easy for you to see whether or not you've done the thing you're supposed to do to achieve that goal. For example, when your goal is to risk exactly 1% of your trading account capital on every trade you take, if you take a trade and you risk 2%, for example, then obviously it's very, very clear that you haven't followed, done what you're supposed to do to achieve that goal. It's really that specific, okay? And it's also measurable. Measurable in the sense that, using the same example, if you were to risk 1% of your trading account capital on each trade you take, and that's your goal for the month or for the year, and you end up taking a trade where you're risking 2% of your account capital, this is measurable in the sense that it's easily quantifiable. There's a difference between 1% and 2%. So when you see that the trade that you took, even if it was a winning trade or a losing trade, you were risking 1% or you were risking 2% on the trade instead of 1%, it's measurable to see that you did not follow that rule, that plan that you had. Okay? So again, the third acronym is achievable. So assuming now you wanted to set a goal of taking like 30 trades, following a proven trading strategy that you've tested. You've back-tested it, you've tested it with out-of-sample historical data, you've tested it live in the live markets, okay, on a small account or whatever the case might be. Now you've proven that that trading strategy, that particular trading technique, that trading edge, you've proven that it works. And so now your goal is to take 30 trades, the next 30 trades that the strategy signals to you without changing a single thing, or refusing to take a trade setup, maybe because of a couple of losses that you encountered or anything like that. Regardless of the outcome of every trade you take, your goal is to take the next 30 trades. Okay? Now, the third acronym of the SMART goal setting framework is the achievability of that particular goal. So when you set a goal of saying, I want to take the next 30 trades, is that achievable? Of course it is. If by God's grace you live to trade the next 30 trades, obviously, if you don't get in your own way, then you're going to take those 30 trades, regardless, because you're not just going to see assuming you're doing what you're supposed to do, you're not going to see a trade setup pop up, and you know that your goal is to take the next 30 trades, regardless of the outcome of the trades you took in the past, then you're going to obviously take that trade. If you don't take the trade, then it's easy for you to see that you haven't done what you're supposed to do to achieve that goal. Okay? But let's say, for example, okay, your goal was to take, the next 100,000 trades. Okay, so if this is a swing trading strategy, for example, you and I know that swing trading, you might just get like, assuming you're trading only one currency pair, for example, you might just get one or two trade setups, maybe one or two trade setups in a week. Okay, and there are times that, a whole week will come and pass, and if you're using something like a mechanical trading strategy, you might not even get a signal to take a trade within that whole trading period. Okay, now if you set a goal of saying, I want to take the next 100,000 trades with my swing trading strategy, then obviously that might not be achievable, in the sense that let's just do a quick math here. Assuming it would take you around, let's say, this is a rough math. Okay, this is a rough math. Assuming on average, your trading strategy, which in this case, in this example, is a swing trading strategy, assuming it only signals 6 trades to you every single month, and your goal is to take 100,000 trades with that strategy. Okay, now what you do is 100,000 trades divided by 6 trades. This would mean, for each month, I'm dividing 100,000 by 6 in this example because we want to see how many months we would use to take the trades that you're setting the goal to take here. So in this case, it's going to be an approximately 16,000 months, 660. Let's just say 16,667 months. So in this case, let's even just round the number and say 16,650 months. 16,650 months. Now, when you divide this by 12, this is the number of months that we have in a year. Okay? So if you divide 16,650 by 12 months, this is going to give you 1,387 years. Now, I don't know about you, but the average lifespan of a human being on the planet Earth is around 60 to 70 years. So if you're not going to live way out of that range, and maybe trading is still a thing that is something for you by then obviously for you to achieve this goal, you need to live at least about 1,400 years. Obviously, it's going to be, if you're just using the specific number, you're going to need to live around 1,387 years. And that's assuming you remain disciplined and keep trading and do everything like you're supposed to do. So in this case, this particular goal is actually not achievable. Maybe for most people, for the average regular human being, it's not achievable. Okay? And so this is why when you set goals, you want to set goals that not only are they realistic, not only are they measurable and specific, but you also want them to be achievable. When you say your goal is to take like the next 30 trades using your swing trading strategy, and it gives you an average of 6 trades per month, then that 30 trade might fall in between maybe 6 to 12 months of trading, which hopefully is something that is very realistic. God willing, we're being optimistic here, that you'd live through. Okay? So, moving forward, the next thing is your goal needs to be realistic. And this is what I just alluded to. Okay? When we talked about you taking a 100,000 trades in the example of your goal being achievable, and then we talked about it not being realistic, even though it might be achievable for some people. Okay, assuming you're living thousands of years, or you're just different like that. Assuming you're able to do it, for most people, that's not realistic. Okay, and so that's why we want to set a goal that not only can we achieve it, but actually doing that is even realistic. Okay, and the last but not the least is the time-bound factor of your goal. You want to set a goal that you are going to be able to track at the end of a specific period of time. So, for example, if your goal was to take 100 trades using your swing trading strategy, which you've back-tested, tested, live-tested, and you've proven that it works, it gives you an edge over the market. Okay? But then your goal was just to take 100 trades with that particular trading strategy. The thing is, it might take you a very long time to achieve that goal. And if you don't have any time specificity for that particular time that you need to hit that goal within, then you might procrastinate on that goal, and that's not a good thing. Okay, and so what you would want to do is set a time limit for the goal. So, for example, you could say something like, "I want to take 30 trades using 100 trades using my swing trading strategy over the period of the next 12 months." So one of two things need to happen. It's either you hit your 100 trades goal within the next 12 months, or at the end of the 12-month period, you're going to stop and reassess how you've performed. Did you take up to that 100 trades goal following the strategy's rules without breaking it? Then that's a huge win, because you actually followed the goal that you set. But if you are unable to hit those 100 goal set that you set at the end of that 1 year period, then you're going to assess, okay, was this due to my own fault? Maybe the strategy gave me a couple of setups that I didn't take because I wasn't around, or I wasn't feeling like taking them because of emotions like greed, fear, or revenge trading, or all of those things. Okay, so when you do things like this, it's going to be easy for you to have kind of like a milestone which you would use to stop and track what you've done, the goal that you set, to track your performance. Okay, so having a time bound mechanism for whatever goal you set is a very good thing, because it will help you to easily evaluate your performance, or how you are working towards achieving that goal. Okay, so moving forward, another thing I would like you to really focus on is trading in batches, or sample sizes, as we like to call it. So let me give you an example. Most of the time, when you find beginners who are just kind of new to trading, they don't have much experience with trading, you're going to find that they tend to overly focus on the outcome of every single trade that they take, while the professionals actually rarely ever do this. The reason is because the professional trader knows that no matter how good a trading setup looks, no matter how many confluences it gives you, no matter whatever the case might be regarding a trading setup, it's not 100% certain that it's going to work out the way you are expecting it to work out. So, for example, let's say you're trading based on support and resistance levels or whatever, something very simple like that. Okay, now let's use this as an example. Okay, let's say you're trading based on support and resistances, and your trading strategy is very, very simple. In the past, a price tried to break below this level and it failed to do so. And we were in a kind of like a downtrending market because price was forming lower lows and lower highs. Lower lows eventually, even though this was a weak break, price eventually, slightly broke below this previous low and then it pulled back. Okay. So now let's assume that all this price action didn't happen here. And so you saw that, being the support and resistance trader that you are, you saw that in the past, price was struggling to break below this level. And not only that, the market has been kind of like in a downtrending market structure. It's been forming the market structure of a downtrending market. And so when price came back to this level and it was struggling to break below this level, you would have said, okay, this is a good short trade setup. And so maybe you might have had confluences that, okay, we're in a downtrending market. Maybe the higher time frame is also in a downtrend. We're just having a slight retracement and all of those things, okay? And so you decided this is a good time for you to take a short trade setup on this currency pair. And so you took a short trade setup when price when price was struggling to break below this low, and it ended up forming this candle here, okay, this bearish candle. And so your stop loss was kind of right above this resistance area because for whatever reason, you know that if price was to break above this level, then the reason why you're taking this trade is no longer valid, because you're actually taking this trade because you are of the opinion that this resistance is going to hold, and so price is likely going to just continue moving down. Now, for a newbie trader that just learned how to trade with support and resistances, for example, let's assume his trading mentor must have shown him examples of trades using the support and resistance trading strategy, trades that actually worked out. And not throwing shades on the mentor or anything, but let's assume this was kind of like an overzealous mentor that didn't really hammer it into the guy's skull that no matter how good a trade setup looks, there is always risk associated with trading. And so he thought that, because of the good winning trade examples that he saw, whenever he sees any trade based on the support and resistance strategy, because it works, obviously because of the examples that he saw, it's just going to work out. And so instead of him doing due diligence, meaning after he's seen the setup, he still knows that there's a likelihood, a very, very high likelihood that price would either do what he wants it to do, which is move in his favor and hit his profit target, or there's a chance that price will do what he doesn't want it to do, and he's going to go against his trade and hit his stop loss. So he should prepare for that by practicing proper risk management. But because he wasn't given that orientation, or he was given that orientation but he chose to ignore it because, he just doesn't want to believe that losses for this particular strategy are possible, then he might not do the proper risk management. Either he doesn't even place a stop loss altogether, or he places a stop loss, but he ends up risking much more than he's supposed to risk, much more than the recommended 1% risk per trade, which we advise you guys to use. And so after taking this trade, immediately he saw price moving in his favor. He was so happy, and maybe he even added more trades to this short trade, only for price to reverse against him and go straight to hit his profit stop loss order here. In this case, he would have lost this trade. And let's assume he was going for a risk to reward ratio of 1:2. So price would have come slightly, moved in his favor, but it never really hit his profit target before it reversed against him and hit his stop loss. Now, for a professional trader who knows that the outcome of any single trade he takes is not set in stone or it's not guaranteed, it wouldn't even cross his mind to risk something like 50% of his account's capital on a single trade. It wouldn't even cross his mind because he knows that markets are full of uncertainty no matter how good the trading setup look. Okay? And so because of this professional trader knows that for him to be able to make it through trading, for him to be able to make profits through trading, he needs to understand that even though his trading strategy works, he actually needs to take a large number of trades for the edge that his trading strategy provides to actually work in his favor. So, for example, let's assume that whenever he takes a trade, he risks 1% of his trading account capital on each trade he takes. And whenever he takes that same trade, he goes for a profit target of, for this example, let's just say he goes for a 3R profit target. So when he risks 1%, he's aiming to make a profit of 3%. Now he understands that on a day-to-day basis or on a trade-by-trade basis, he can't know with pinpoint accuracy which trade is going to be a winning trade and which trade is going to be a losing trade. But overall, he knows that the strategy he's using to trade is going to give him an edge over the market. Not just that, coupling that trading strategy with proper risk management, risk and money management, with the right mindset. So what I mean by the right mindset is, after he takes like 3 or 4 or 5 losing trades in a row, he doesn't start doubting the strategy. And so the next setup he sees, he refused to take the setup because of the past losses that he's had. He understands that losses are just part of the game. So even though he has 10 losses in a row, when he sees on the next setup that his strategy gives him, he's going to take it without asking any questions or without any hesitation. Okay? And when he takes like 5 or 6 or 7 winning trades in a row, he doesn't get overconfident, and instead of continuing to risk 1% of his account capital per trade, he gets overconfident and greedy and starts risking 50% of his account capital because he wants to double or triple his account capital in a single trade. He doesn't do any of these things. His risk is consistent and professional, risking 1% and nothing more. Okay? So he understands this, and he understands that for his edge, for the advantage that he has over the market to play out in his favor, he needs to take a large number of trades. So for this particular example, let's assume that his goal is to take 100 trades because he knows that after taking 100 trades, he's definitely going to win some, just like he's definitely going to lose some. But because his losses are capped and his wins are far greater than his losses, eventually he's going to get an edge which will give him a positive expectancy. So in this case, let's assume that after taking those 100 trades, let's even assume that, price didn't treat him well. And so he barely managed to win 30 out of those 100 trades that he took. The remaining 70 trades that he took were all losing trades. But remember, this is a professional. He understands that he needs to take large number of trades for his edge to play out. And so he never really played with this risk management. Whenever he lost money on a trade, it was exactly 1% of his trading account starting balance. And in this case, his gross loss would be 1% times the 70 losing trades that he took. So his gross loss would be minus 70%, because each losing trade cost him a loss of minus 1%. Now, what about his gross profit? Remember, I told you that he had 30 winning trades, and each one of those winning trades gave him a profit of 3%. Okay? And so 30 times 3 would give you plus 90%. Now, when you subtract the gross loss from the gross profit, you'd end up with a net profit of plus 20%. So even though after taking 100 trades, his win rate was only 30%, just think about this for a minute. He lost 70% of the trades that he took. But because his risk management was on point and his psychology was also on point, whenever he saw a trade setup, he took the trade without hesitation. Whether he had, the past couple of trades he took were losing trades or winning trades, it didn't really bother him. And he practiced proper risk management. He kept doing this until he took those 100 trades. At the end of the day, he would have still end up making a profit of 20%. If this guy was trading with a big account, which is what we actually recommend, okay? If you have the capital to trade with, obviously go ahead and do it. But if you don't, you get access to private investors' capital or prop firms or all of that. So assuming you're trading something like $100,000 account, 20% on $100,000 is $20,000. And even if this was a prop firm account, 80% of that profit is going to go to you. And I know if you're living in anywhere that is not, even in Europe, making this type of money on a, let's say, quarter or month by month basis is something that you can live off of. Okay? And so this is how professional traders do. They don't overly focus on the outcome of a single trade. Rather, they think of taking trades in batches or sample sizes. While you notice that most of the times, it's the inexperienced traders or the beginners or the rookies who are struggling to become profitable that will take a trade, and if it doesn't hit their profit target immediately on that particular trade, they go bonkers. It's like, oh, this strategy doesn't work. They want to dump it and start looking for another one. And every sort of mistake. Okay? And so please, because of this, do like the professionals and only set goals to take trades in batches. If you've tested that your trading strategy works over historical data, using back tests and forward tests and live tests or whatever the case might be, then set or commit to taking a number of trades with that particular trading strategy, following all of its rules without deviation, without being undisciplined, or without letting your emotions call the shots, and then watch how this would unfold in your favor. Journal your trades, review your trades, do all of these things, and you're on the path of becoming a consistently profitable trader. And that's how it's done, guys. That's actually how it's done. Okay? And so this pretty much brings us to the end of this week's edition of the class. But before we round up, as usual, I'd like to use this opportunity to invite you guys to test out our suite of ITU bots, which are designed to help you become consistently profitable traders using automated trading strategies. The bots are designed to look for low risk, high probability trading setups on your behalf, place those trades for you with proper risk management as long as you follow our recommendations, and they're designed to help you start earning while you're learning how to trade. So you can choose to devote a portion of your portfolio to automated trading using the bots and a portion to manually trading with strategies that we teach you in the ITU Forex classes, and you could, diversify your investments and all of that. So if you're interested, please reach out to us on any of our social handles or leave a comment in the question on the comments section below, and we'll be more than happy to assist you set everything up in a step-by-step manner. And last but not least, I would like to thank you guys again for using this, for taking the time to come to these classes out of your busy schedules and being as interactive and all of the things you've been. We really appreciate it, and we look forward to seeing you guys in next week's edition of the class. Once again, thank you, and God bless you all. Have a nice rest of your week. Cheers.